This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Matt back on the show. Now let's get to the chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Matt's picture saying, looking for the downloads. Okay, Eric, what are your thoughts here on the equity markets?
Well, Patrick, as I explained last week, the big thing to watch for on the S&P futures chart was a close above the 200-day moving average, and specifically whether or not a close above that level would bring on an acceleration to the upside or if we'd see a failure at that level. Well, we got our first close above the 200-day on Monday, but instead of accelerating to the upside, Tuesday saw only a very slightly higher high than Monday. That was the first big tell that all was not well. Then Wednesday gave us a big red candle to close back below the 200-day moving average, testing the 8-day moving average during intraday trading and then closing right on top of the 5-day moving average. Now, we still don't have a decisive technical signal until we see a close below the lowest of the three short-term moving averages, which right now is the 13-day moving average at 56.98, 5698. But so far, all indications are that the failure of this rally just above the 200-day moving average that both Patrick and I warned about last week may already be upon us.
Eric, I want to just take a look at this market from one context, right? Which is, okay, it could always rally all the way back to previous highs. Things could turn bullish and the market can go ripping higher. It'll get above all of its moving averages and we'll have to acknowledge a new bull trend. But I wanted to step back and ask, well, is this correction already over? Is this enough for what is a typical market correction? If we are underway in some sort of a bigger, deeper mean reversion of this huge multi-year bull market that we've had over the last 2 years, what do these corrections look like? And so what we had was this 3-week market drop that was about 10%. And it was incredibly oversold, overdue for a market bounce, and now we got a market bounce. And so you can see that on page 2 where we have the chart of the S&P 500 as we've now approached a 50% retracement and the 50-day moving average. So what I wanted to do was go back in history and look at previous market corrections and how they started. And so on page 3, I went back to the start of the 2022 bear market. And that's just recent. It was just like 3 years ago. And what we want to highlight is back in January of 2022, the market started with about a 3-week market drop that was about 12%. And in the subsequent 2 weeks, we had a 9% market rally that was like a short squeeze, reflexive rally that basically came right back to the 50-day moving average before the whole market rolled over and began its next leg of selling. On page 4, I go back to the Christmas massacre back in 2018. And back in October of 2018, we had a market that dropped 16% in the first 30 days. After such a violent market drop, the market proceeded to have an 8% market rally in the following 2 weeks that once again came back to retest the 50-day moving average. After that test, over the following 2 months, the market proceeded to have another major leg down. Then I wanted to go on page 5 to the top during the 2007-2008 bear market. And what I want to highlight there is in October of 2007, after putting in its market top, the market proceeded over the following month to have a 11.5% market drop in just over a month. It then proceeded to have an 8.5% market rally, a short squeeze, that lasted just about 2 weeks. So I think that every one of our listeners can start to see a pattern, which is there's this first leg down and then a market bounce. So on page 6, I have the current market, which is we basically had a 10.5% market correction. And so far, we've had about a 6% market rally as we've approached this 50-day moving average. The point that I want to highlight is that so far, this analog has just fit perfectly with that of all of the prior kind of starting points of something bigger. And so this inflection point around this 50-day moving average, as we're up the 6, 7, 8% off of the lows, is actually going to be a very critical moment, because if this is a bigger sell-off, if this is a bigger market turn, this going here into the first week of April is a highly vulnerable moment where the market can turn. And with us having things like the tariff announcements on April 2nd and the roll-off of this JP Morgan options whale, which has that dealer positioning has influenced short-term flows, and that will be rolled off. Once all of these things are recalibrated, next week is going to just be critical for the markets. And this is, I can't think of a more interesting time, or more important time, if I should say, that our listeners need to consider what positions they have in their portfolios and should they be hedged on them.
Patrick, with what looks to me like a failed rally topping out here, I want to revisit our hedging conversation from last week. Now, you talked about collar strategies, and you explained last week that buying puts to outright hedge downside risk was maybe a dubious trade because of the elevated VIX, meaning that you'd be paying through the nose for those puts. But the VIX dropped back into the teens this week, and meanwhile, it looks to me like the S&P might have already peaked, and it's already back below its 200-day moving average. So it seems to me that while last week might not have been a smart time to outright hedge downside risk with puts or put spreads, maybe this week is. Is that right? And if so, tell us the best strategies to take advantage of this vol dip and potential dead cat top.
Let's break this down. First, let's address the issue of the cost of hedging. And hedging costs are associated with volatility. So on page 7, I have the VIX chart, and we can see that even a week ago, we were up in the mid to high 20s on volatility, up at peaks near 28% implieds. And now we've gotten down to the 17, 18 handle on the VIX. So we've already had this substantial reversion of volatility, so that options that were very expensive for the cost of hedging just a week or two ago have come back in. Now, we're not down at the 12 to 15% level on the VIX, which is typically where we would see it during bull markets, but this isn't necessarily a bull market. So we are actually talking about a level where hedges are once again at least somewhat reasonably priced. But on page 8, I wanted to look at the longer dated VIX. In this case, the 6-month VIX. And while we did also have a spike in the volatility index for longer dated options up to about the 25 level, we've quickly come back down to the 20% level on those longer dated VIX levels. Now, what you can see on this chart is the fact that over the last 6 months, this 19 to 20% range has been the lower end of the cost of these options. And so we're in a situation where today buying a longer dated hedge is actually reasonably priced in line with the cost it would have been over the last 6 months. So we right now don't have an options market that is pricing in big amounts of fear, and therefore the cost of hedging is still very reasonable. Now, you specifically referenced the collar strategy, and I actually love the collar strategy. It's a fantastic way to reduce the cost of your hedges, which is you're buying a protective put to hedge out the downside risk, and you're helping finance that cost of that put by selling calls up above. Now, often this cannot be done at zero cost when you're going the equal distances because of the natural skews in the market. And but even if you can substantially reduce the cost of your hedge, it still goes a long way. So first of all, before we do an example, I just want to address the simple issue of why collar at all. Well, first of all, if you're in a position where you believe that on the short to intermediate term that the market has no upside momentum and or has limited short-term potential on the upside, then selling away a part of that upside potential to help finance the cost of that downside insurance is a complete no-brainer. So as an example, I'm just going to use the S&P 500. Now, the beautiful thing is collars can be built on individual stocks, on individual ETFs. In this case, I'm just going to use the cash index for simplicity. Now, with the at the time we're recording this, the SPX was trading around 5,700. And so if we did a collar where we sold a covered call 5% higher and proceeded to buy a protective put 5% lower in the market, that can be done at a net cost of 20 S&P points, which is like spot 0.003% cost of the trade going out a month and a half. Now, for that cost, you have basically contained all volatility you're going to experience, both the upside and downside, to within a 5% band over the next month and a half. To some people, this will give them a little bit of ease in holding through some of these very turbulent times. But to me, it's not just about reducing portfolio volatility, but it's about the fact that if the market was to have a big downside event, it's that moment when you want and need cash, and that cash comes from closing out the collar hedge. And that cash injection allows you to have money to buy the opportunities of that dropped market. So if you don't hedge, then you're feeling all of this pain and you're strapped on cash on the downside, while if you're hedged, you get all of this extra cash. You can use it to whether do some form of dollar cost averaging or stock repair strategy, or simply take on brand new opportunities. And that's something that is often overlooked when considering whether or not to hedge a position.
Patrick, after you had a great turnout for your stock repair webinar, you're doing another special webinar for your Big Picture Trading members. Where can listeners find that, and is it free to attend for MacroVoices listeners?
Thanks, Eric. With the market bounce now testing the 50-day moving average and the VIX down in the teens again, it is a very opportune time to do a webinar again on hedging downside risks and or profiting from a further decline. We will be hosting a webinar on Tuesday, April 1st at 4 p.m. Eastern Standard Time. Listeners can find the link in the Research Roundup email and or visit the homepage of bigpicturetrading.com. All right, Eric, let's move on to the dollar.
Tuesday saw our first close above 104 on the Dixie in weeks, but then we closed just below it again on Wednesday. Now, if we can get back above 104 and stay there for a few days, it's a likely tell that we might be headed back up to test 106.
Eric, it's amazing how much a 1 month difference makes. Like when we go back a month ago, we were trading above 2-year trade range. It was looking like just a consolidation wedge for a continuation pattern. There was even an attempt to break back above the 50-day moving average. Everything still looked like it could turn bullish. Suddenly, over the last 3-4 weeks, not only we had a violent breakdown deep into the trade range, but the rallies have been incredibly weak. And so under this kind of an environment, the price action has dynamically shifted, very distributive in nature. I'm taking a very neutral stance here on the dollar. There is vulnerability that we could go to the bottom of the trade range near 100 and or even bounce back to 105. But overall, the idea of a big bullish impulse higher on the dollar has quickly closed. And so at this juncture, I would be taking a very neutral stance. And I think that new trends will develop later in the year. But right now, let's just see how high this bounce goes and whether it triggers another round of selling to go test the 100 level down below. All right, Eric, let's move on to oil.
Well, overnight, we were above the 100-day moving average on WTI at 69.71, but as of recording time, we're back below it again. As Lynn Alden said last week, we're in a headline-driven market, and to be sure, the headline that the Trump administration was demanding that Iran shut down all of its uranium enrichment, including both civilian and military, well, that definitely helped us get here to this elevated level. So is this the beginning of a gigantic upside move driven by geopolitical escalation that could take us into the 90s? Or is this a blip that's soon to retrace back down to the 52-week lows around 65? Well, that's going to depend on those headlines. If there's further escalation with Iran, anything's possible to the upside. Absent further escalation, I think we probably drift back down to the lows, if not lower.
Well, Eric, we were long overdue for a bounce, and we finally got it. The 69 to 70 level was a bare minimum bounce. Not only was that the 50-day moving average, but it was about the fib retracement zone of the last leg of the selling in late February into early March. Now that we've gotten here, we could obviously still tack on even a few extra dollars to retest the top of the trade range that was established in the fourth quarter of last year, which was about a $72 high. But I think that there's going to be a little bit more work in the months to come for oil to truly establish the basing accumulation pattern that would allow a new bullish move. And so I think it's too early for one to already speculate that a new bull run is underway. And it's definitely an oversold bounce. Now we want to see whether accumulation starts to show itself. All right, Eric, let's touch on gold here.
Well, first of all, there's a little bit of an illusion on the chart. If it looks to you like this was a gigantic up week for gold, it's probably just that you're seeing about $30 of contango that was captured in the contract roll. So that's not really an increase in the spot price of gold. It's just the matter of the June contract, which we've rolled into, being at a higher price all along than the April contract that we just rolled out of. Moving on to the technical indications, after gold was signaling an extreme overbought condition on the daily chart, the slow stochastics are back below overbought levels and pointed down now, suggesting either a continued consolidation or an outright move lower might be in the cards short term. Meanwhile, the RSI is still overbought, but it's not extreme overbought like it was a couple of weeks ago. On the weekly chart, however, the RSI is still well above 80, a sign that we could see a prolonged period of consolidation or lower prices in the intermediate term. Now, I'm definitely not calling a top here. Patrick, as you've said, there could easily be another $200 of upside from here before this market hits a cyclical top. But I do think the near-term bullish argument is getting less and less compelling as we've already come so far so fast to the upside. Longer term, I remain extremely bullish, but for now, I'm continuing to take profits, raising cash earmarked for buying uranium at lower prices, which I think are still to come.
Eric, on page 11, I have that chart on gold, and what a beautiful bull trend this has been. Just higher highs, higher lows. The accumulation is very distinct. Now, obviously, some people are trying to highlight that it seems a little overdone and overstretched. I get it, but there is zero sign in the price action, and the measured moves are still targeting levels as high as 3,200 on the interim. And so anticipating gold will be able to continue this short-term trend makes sense. Often, something that has this strong of a bull trend can often end with some sort of acceleration to the upside as it really becomes incredibly popular. It'll be very interesting to see whether we start seeing almost an acceleration in this, or whether it gets very heavy to create topping formations that show some form of exhaustion. Right now, it's a very clean bull trend, and neither of those are very evident. Now, Eric, last week we had a little bit of action in uranium as it bounced from some very oversold conditions. What are you thinking here?
Well, last week I cautioned that while I'm uber bullish intermediate to long term, the daily stochastics and RSIs were climbing back up toward overbought territory. Well, they got there this week. They peaked, and as anticipated, they turned back down. So now I think we're in the midst of another swing lower. The big question is whether we put in a new lower low below the early March low, or if we put in a double bottom, or if this next swing that we're seeing beginning right now over the next couple of weeks takes us down to a new higher low, which would be the first higher low in this cycle. Which of those things we get next is going to be a strong tell on whether or not the bottom is actually in. But I continue to also feel that the real risk here is a broader market risk event. If we get into a full-on cyclical bear market in equities, and with that potentially topping out dead cat bounce that we saw just above the 200-day moving average, if that doesn't recover pretty soon, it might mean that uranium miners are about to follow the broader stock market down to new, considerably lower lows. If all of that happens, I'll be eagerly adding to my already overweight longs, but there's definitely room for a whole lot more downside here if the broader market tanks. Now, I have no idea how long this rout will last, but I'm supremely confident that these are already bargain prices on uranium mining shares, and I'm hopeful, actually, that even better bargains are likely still to come before this is over, because I'm definitely keen to buy more uranium here, especially if we can get down to new lower lows.
Well, Eric, while I have a very bullish view on uranium in the long term from a fundamental perspective, over the last few months, we've been very clear identifying that this has been trading below the 50-day moving average in a distributive pattern, lower highs, lower lows. But the thing that we observed over the last few weeks is that the downside momentum has dissipated. There's almost an exhaustion of selling where there's just no more marginal sellers on the downside. On the spot physical uranium, this looks like around the $20 level, a logical place to find support lines. But it's going to take a while, very similar to oil, for this to start turning bullish. We have to see bottoming formations, accumulation patterns, anything that shows signs of life. This bounce right here, while it's nice to see from a very oversold condition, is still very premature to start to jump to conclusions that some new bullish impulse is underway. Finally, Eric, we talked about the idea of how copper is trading in the COMEX versus the LME. What are your thoughts here?
Well, Patrick, I was musing on your comments last week about the mystery of why there's been so little participation by the mining stocks in this massive rally in copper futures on the COMEX Futures Exchange. The reason I emailed you to suggest that we include a chart in the deck this week showing both COMEX and LME pricing on copper is that I think the massive rally in COMEX copper futures happened because that HG contract is for U.S. delivery. And I think that what it's reflecting is traders front-running Trump's tariffs on copper imports. So for those who are convinced that the Trump tariffs won't last forever, there's a really compelling pairs trade setting up here, but only if you're willing to ride out a possibly wild ride on the J-curve of pain before profit. Now, if tariffs are not forever, then this huge disparity between the LME and COMEX pricing won't last forever either. That means you could put on a levered pairs trade, going short COMEX copper futures and long LME copper in the same notional principal amount on the rationale that they have to reconverge eventually after this tariff situation blows over. But of course, the risk is getting shaken out of that trade if this disparity gets even wider between COMEX and LME prices. And let's face it, folks, if there's anyone on earth who could create more disparity, for lack of a more polite word, between the U.S. and Europe, President Trump is my man.
Well, Eric, I actually agree with you. This is clearly something to do with the tariffs, but one of the things is that when something gains this much momentum on the upside, it can actually still keep going. And while it seems like a logical trade to fade the COMEX copper against the long on the CME, it will inevitably mean revert. But on the very short term, I don't want to stand on the railroad tracks trying to call the turn point here. This could last still weeks more, and the divergence can actually continue to widen. And so I'd be cautious, but it really does show that when you're looking at these copper stocks and copper prices on an international basis, that the momentum hasn't really accelerated outside of that COMEX contract.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.